In a tight 48-hour window, over $90 million in Bitcoin leverage was wiped out as the price flushed straight down to $58,000. This heat map shows the immediate aftermath of that event. You can see the price flatlining right at the 58,000 baseline. To understand why this violent drop occurred, we have to isolate the exact liquidation clusters that engineered the volatility. Prior to the drop, large pools of both institutional and retail capital were trapped inside a narrow sideways trading range. This chart shows the state of the market days earlier, revealing the specific high-leverage zones that acted as the primary catalysts. The capital was clustered tightly at the $63,500 and $65,000 levels. These dense clusters create liquidity magnetism. Market makers target these price zones because they need the concentrated volume to fulfill massive orders with minimal slippage. The data suggests this crash functioned as a mechanical clearing of the order book. We can see this more clearly by breaking down the chronological sequence of the move. By the time price hit $58,000, retail sentiment reached a cyclical low. Simultaneously, the underlying structural data began exhibiting characteristics that historically precede a sharp reversal. Our objective is to mathematically map the price vector's next magnetic target. Drop a like and share if you find this valuable. This diagram illustrates a notional risk reset. A heavy leverage flush clears the board. This reset to zero is required to free up algorithmic bandwidth before the next trend can establish itself. Leverage density acts as a highly reliable leading indicator for price action. On June 21st, price entered a tight consolidation phase near 64,000. This heat map shows the danger of ranging markets. Traders use low volatility to pile leverage onto both sides. Notice the density of the purple color in the safe zones, contrasted with the heavy yellow bands building at the 65,000 resistance. Tracking the heat map into June 22nd, you can see the magnetism intensifying. Price begins oscillating directly between the dense clusters. When bilateral leverage reaches a critical threshold, a volatility expansion becomes mathematically certain. The pressure must be released. This chart highlights the failed breakout on June 23rd. The rejection at 65,000 signaled that a downside sweep was now the path of least resistance. Make sure to subscribe to the YouTube channel. By late June 23rd, the board was dangerously top-heavy with long positions. The flush was inevitable. The market shifted immediately from range-bound consolidation into a phase of active liquidity hunting, ruthlessly targeting the lower bands. Looking at the June 24th heat map, we see the initial slide. The price vector is consuming the long liquidity that built up during the previous 3 days. This triggers a cascading liquidation. Forced sellers hit the market all at once, creating a self-reinforcing downward spiral. This line chart highlights a disconnect. Price is falling vertically while the hash rate remains flat and stable. The network infrastructure was unaffected by the price volatility. On this June 25th heat map, we see the final capitulation event. The price drops vertically to 58,000, fulfilling the algorithmic goal of the sweep. Follow us on Twitter for more updates. The flush successfully purged the overleveraged longs, completing the notional risk reset. At the 58,000 bottom, maximum retail bearishness takes over. Traders assume the trend will continue, leading to a massive influx of late entry short positions. This chart captures the brief consolidation period following the crash. The magnetism has already shifted upward. This yellow band on the heat map at 61,000 confirms that late shorts are now piling in aggressively. These late shorts are highly vulnerable. They provide the perfect exit liquidity for large market participants executing a reversal. The high density of short leverage made a rapid mean reversion the highest probability vector. The bounce on June 26th is outlier behavior. It is driven by a coordinated squeeze, rather than organic spot buying. On this heat map, you can track the price moving aggressively upward, targeting the 61,000 and 62,000 yellow bands. The price vector moves specifically to consume the late shorters' liquidity, punishing the traders who entered at the bottom. Subscribe to the YouTube channel for more updates. The board wipe is now complete. Longs were purged on the way down, and shorts were purged on the way back up. This final chart synthesizes the entire 7-day cycle. The board has been reset, and price is now consolidating in a new range at 60,000. Price discovery in this market is driven by the search for leverage density. Drop a like and share if you find this valuable, and subscribe to the YouTube channel. The liquidity magnetism cycle cleanses the market of excess risk, rebuilding the foundation for the next structural move.